Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value and entertainment out of these videos, all I ask you to hit thumbs up and subscribe. Questions, comments, put those below. I've been talking a lot about in these videos on the recent Canadian housing boom. Obviously, it's what I do day to day for my living. And I said, from the get-go, and I've been saying in these videos, I said it in my newsletters, that this housing boom was manufactured in Ottawa, because I'm getting a lot of reporters again and people on social media commenting and saying, there's is it investors, is it speculators, is it people flipping properties, what is it? Everybody's so confused. And as I've said time and time again, no, listen, this housing boom was actually manufactured by design in Ottawa. And everybody, it's like, well, that sounds kind of conspiracy theory. Why would they do that? They want affordable housing, don't they? We're trying to work towards affordable housing. Why would they manufacture a housing boom and push house prices up? That doesn't make any sense. But again, it doesn't matter what they tell you what they want. This is what they're doing. So you look at their playbook, and we've talked about this before. Is during the onset of the pandemic, we had a set of regulations and policy decisions that were brought into place that were specifically designed to create credit, get it out the door and into the housing market, to basically spur a rise in asset prices and to spur a wealth effect and to spur consumer spending. So they need to get credit out the winning. Multitude of ways they did that. The OSFI lowered the capital reserve requirements, basically allowing banks to lend essentially as much credit as they want. You had CMHC come in and create the Insured Mortgage Purchase Program, the IMPP, where essentially they take a lot of these mortgages off the bank's balance sheets, again, increasing lending capacity. Same thing by the Bank of Canada buying Canada mortgage bonds, all designed to increase lending capacity through commercial banks. And obviously lowering interest rates and the host of quantitative easing, all designed to lower borrowing rates to then stem borrowing. So manufactured in Ottawa, and lo and behold, from the grave, Stephen Poloz at the Bank of Canada coming out this past yesterday, as of filming this video, his comments with BNN Bloomberg right here.
On the economy, the faster we go, the less of that there will be. So I think there's a lot to be said for this policy. And like I said, if it turns out that interest rates are half a point higher than they otherwise would be, that's a good thing, because it means less expansionary speculation, maybe less heat in the housing market and that sort of thing. So a more balanced kind of economy.
I know this was something on your mind as central bank governor. It's been on the minds of Western bank governors, and that is that kind of permanent setback, the capacity that's lost forever. Because we have had this amazing fiscal input here in Canada and the U.S., have we avoided the worst case scenario there, in your view? I mean, I know it's something we can only know retroactively, but do you feel good about the trajectory we're on?
I feel very good about it, and I think we have done a pretty good job. Afterwards, you never say it's perfect, but in the heat of the action, I think it was extremely well done. And I think what that means then is that the economy will, every time it gets opened up again, right, we take the restrictions off, it bounces right back. So most of the damage, or the people who have lost their jobs, or businesses that are under threat, most of them are in sectors that are used to high turnover. Such as restaurants and small retail. And so the bounce back was very impressive that we saw in the fall. And I think we're going to see it again this spring, especially as the vaccinations gradually build momentum. So that just shows the underlying economy is actually quite healthy. When we started all this, unemployment was at a 40-year low. Inflation was right on target. You can't be in a better place to have a shock.
So this guy says, if the side effects of this extreme monetary policy is a hot housing market and rising house prices, we'll take that every time. Sorry, millennials, and I feel really sorry for people that are working, in a 9-to-5, making 60, 70, 80,000 bucks a year, making an honest living, because your currency is just being absolutely obliterated right in your face. And obviously you're not being compensated for that. And so we have got rampant asset price inflation. And again, as I've said before, this is the intended, not the unintended, this is the intended consequences of QE. It is designed to boost asset prices. It's designed to spur a credit boom, and is exactly what they have manufactured. And by doing this, again, you can't simply just create a whole bunch of money or create a whole bunch of credit, i.e. money, and not have repercussions. There's haves and the have-nots. And so let's just look at the Canadian house price acceleration here over the past several months. I mean, you've got just rampant house price appreciation on an annualized, 1 month annualized basis. I mean, the current trajectory, you'd have 40+% price growth on a year-over-year basis across the nation. Obviously, I'll be the first to say I don't think that's going to sustain itself. I mean, I've got clients right now that are making $200,000, $300,000, $400,000 year over year just based on the value of their home going up. Some of them opting to sell, cash out, and put that money in their pocket and go rent. And so these are unprecedented gains that, again, if you're relying on an income here to get ahead, you can see why people feel like they're falling further and further behind. And I just feel part of this is like, for me, I listen, I watch this, and I understand the game, and I see what's going on. I'm like, okay, so I'm able to make a play with this. I mean, I've been buying real estate since back in November, bought in December, bought another one in January, bought one in February, and some of those are rehab projects, so keep that in mind. But I'm able to look at this and say, holy smokes, like, look at what these guys are doing. Who I feel bad for is the average layman person that doesn't understand monetary policy, and so they maybe don't have a whole lot of investments. Maybe they put their money in a savings account because that's what they've been taught to do. Work hard, save money. Those are the people that are getting really, really hurt by these policies, and you can see it. Anyone that's watching this channel right now, if you're watching this channel, tell me in the comments below that if your friends, for example, or you're part of your family members, ask them like how they're feeling about this housing market. Are they wondering what's driving it? Are they creating all these stories in their head about what's driving? Like the one that I keep seeing is like, oh, this is being driven by those nasty speculators. Everybody's speculating. We need to get rid of all these investors, throw them in jail. Because they don't know who to blame. Everybody's looking around and going, oh my God, who do I blame? In 2016, it was pretty easy to see. You said, oh my God, it's the offshore guy. Look at all these people coming in from China, buying all this real estate. Put in a foreign buyer's tax. The public demanded a foreign buyer's tax. Today, everybody's looking around. They don't know who to blame. And Poloz just came out and just told you, look, we did it. So, they did it. It's amazing to see, the thesis. Again, I've been telling people, I've been banging my fist through the table here. You got to do something. And the Bank of Canada comes out last month. Oh, don't worry. We're watching the housing market. It's showing signs of excess exuberance, but it's only tied to the single family market because people want more space. And no. This guy isn't paying attention. The condo market, at least in Greater Vancouver and Toronto, is accelerating at a rapid pace. I would actually argue that the pace of increases right now in the condo market is running higher on a monthly basis than the single family market. A rising tide lifts all boats. I am sorry to say this, but if single family market goes up 20-25% and the townhouse market goes up 20-25%, there is no way in hell the condo market is going to sit flat. And that's exactly what it's been doing over the last 2 to 3 months. It is ramping up. So the Bank of Canada, again, is lying through their teeth because they can't do anything. They're not going to do anything. That's all lip service. But again, what I will caution, as I've always cautioned in these videos, is I'm trying to get people to understand in simpler terms what is happening here. Because I understand this is a little bit more complicated topic. So I want you to look, it all matters in your unit of account. So what I keep saying to everybody is that, listen, like, these guys are printing money. Okay, so all these programs that come out, the federal government here, you can have a $2,000 CERB check. Landlords will give you some money. Oh, we'll do some wage subsidy. The Bank of Canada is going to buy all the debt. These guys. So everybody's just making up this funny money, and it's losing its worth. So you're devaluing the currency to basically keep the system solvent, and that is reflecting in asset prices. So what I say is look at the Greater Vancouver property market, for example. What you should do is measure it in gold, and we did this premise a couple weeks ago. But thank you, Eric, for putting these charts together for the updated data on the Greater Vancouver housing market. If you look at gold, if you price Greater Vancouver real estate, which again is up 20% year over year, it actually really hasn't moved a whole lot when you actually start pricing it in gold. Price it in the ounce of gold. Gold has been a storehold of value, of wealth. Gold has preserved wealth over hundreds and thousands of years. It has been used as a currency for thousands of years. And so that is really what you should be measuring it at, because every fiat currency in history has gone to zero. There has never been a fiat currency that has survived indefinitely. They all go to zero eventually. And I think that this is the early signs and the early inclinations is that you get rampant asset price appreciation when measured against fiat currencies. So again, when you actually start to measure it in different stores of value, particularly gold, which has a long track record, the price of real estate is not going up. So this is how you need to look at it. And this is what I've been emphasizing to people. And again, as I've said before, the beatings shall continue until morale improves. But speaking of unit of account, I just want to touch on some last bit of news this week. Something that I have been, again, talking about in these videos very, very frequently. And we're starting to see more and more traction. And something that is very relevant here to Canada is there was a condo corporation, a strata corporation in Alberta that just made all these headlines because they were the first strata corporation where they actually took a portion of their contingency reserve funds and they allocated a very small portion of that into the Bitcoin market. So they've now got Bitcoin on their balance sheet. And it's kind of funny because all the people, like, it's 50-50, right? Either you love Bitcoin, you're a huge proponent of it, or you think it's a scam, it's going to zero. So I had all these people flooding in going, oh my God, what a scam, what a huge risk. All these condo owners are going to be going down, they're going under. And I said, well, hold on a minute. Let's agree that there's always a risk that Bitcoin can go to zero. I don't disagree with that. But is there anything riskier? For example, there's condo corporations I can tell you in Vancouver, for sure. I go look at the balance sheet. I go through the StrataDocs, I look at the balance sheet. These guys have $2 million cash in the contingency fund. It's a high rise, right? So they got a big contingency fund. $2 million cash sitting in a GIC yielding 0.5%. That's a guaranteed loss. Over time, that is a guaranteed loss. So if the Bank of Canada says our official inflation mandate is 2%, and you're earning a return of 0.5%, in real terms, you're losing 1.5% per year compounded. So imagine over 10 years, when your elevator comes due and your roof on your strata building needs to be done and you got to redo all the pipes in the building, that $2 million, what's the value of that $2 million? And we can all see plain as day that the cost of materials is going up, the cost of labor is going up, the cost of insurance of these buildings is going up. So the only thing that's more risky than putting a portion of your balance sheet into Bitcoin is holding the whole thing on a GIC earning less than 1%. That is the definition of a guaranteed, over time, guaranteed loss of capital. So again, it's all about how you think about units of account and how you're comparing relative gains. So that's all I got for this week. A little bit around it. I will touch on one last thing. For those of you always looking for book recommendations, this past week, and this is what helped me to understand as I've been articulating in these videos since the onset of the pandemic in April. I told you exactly what was going on and what these central bankers are doing. This is the holy Bible of central banking, of bank credit creation, of really understanding the entire system. This is the Holy Grail. It's called Princes of the Yen by Richard Werner. He is the guy where he documented Japan's housing bubble and crash that followed suit, and the central bankers that actually enabled the crash. So everybody's, what? How did Japan's housing bubble burst? Why did it burst? It was actually by design. And but he was actually the first guy prior to Steve Keen that figured out that banks actually create credit. They're not like deposit institutions that then take it and reserve it out like fractional reserve banking that everybody thinks they are. No, they actually just create fountain pen money essentially. So this book, if you want to understand, what the Bank of Canada is doing, or the textbook, or why they're doing it, this will tell you everything they need to do. They have to create credit through commercial banks. So they had to get banks lending into the residential market in a time of crisis. But again, the repercussions of that are a growing wealth inequality, a growing divide, and I think a slow realization of a failing fiat currency. I think that people are slowly figuring it out, that you need to get out of the currency and into, it pays to leverage yourself to the eyeballs, because they understand the system is broken and they actually can't raise interest rates in order to normalize the system. See you next week.